Welcome to Catalyst. I'm Madison Mills. 30 minutes into the U.S. trading day. Let's get you the three catalysts we're watching this hour. First up, we'll break down trade risk in the market as President Trump ratchets up tariff talks. We're going to have full coverage for you right here ahead. Plus, we break down how to trade Nvidia's earnings with options implying big moves on the back of those results. And we sit down with the CFO of Intuit to break down the company's latest earnings print and how DOGE cuts in Washington are impacting the company. Half an hour into the start of U.S. trading, let's get you a check on the markets. Taking a look at the major averages, we were on track for a soft landing into the holiday weekend here, and then we had that Trump post on Truth Social about those proposed EU tariffs of 50%, and stocks went sliding here. You've got your S&P off 1%, your tech-heavy NASDAQ off about 1.3%. Tech is the biggest laggard at the moment, but all 11 sectors of the S&P are in the red. Let's flip the board over to the bond market, though. You have yields coming in just a touch here, but you've still got your 30-year yield above that 5% level. You've also got your 10-year down about 5 basis points. Bonds catching just a bit of a bid this morning. But finally, let's take a look over at Bitcoin. It is moving to the downside after hitting that record high of 111,000. It is down now a little over 1%. Well, fears of a trade war gripping investors once again. President Trump threatening to impose tariffs on the EU and Apple iPhones. From on this, I want to bring in my guest host for the hour, Hope King. She's the founder of Macro Talk News and a Yahoo Finance contributor. We also have here Amita Schultz. She is a partner and portfolio manager at Cerity Partners. Thank you both for being here, and Hope, thank you for being here for the hour. I do want to start with you because I know you have such an expertise in both the macro and in tech, and this is a great day to have you because we are really hitting both.
Yes, we are.
Talk to me about your reaction specifically to the Apple news.
I mean, it's just every other day you have a new announcement that investors have to digest, consumers have to think about, and it's this whiplash that is really creating this indigestion that I want to talk about today. Like, that is the theme, I feel like, for the markets. They are getting thrown this buffet of just like actually unappetizing, right, dishes. And the latest one this morning is throwing, I mean, futures were off, we're a little bit higher from those future declines this morning, but it's just yet another wrinkle in the whole fabric of the story. So to me, it's a good time to sit back from the table, frankly. I mean, you know, you and I don't invest actively because if we were, we would definitely just be pretty ill at this point.
Yeah, and certainly rethinking our Memorial Day weekend plans.
Oh, yeah.
At a minimum, too. So, Amita, I want to bring you into the conversation. Hopefully your weekend is not ruined by the action this morning. But talk to me about how you're thinking about specifically the trade negotiations and a little bit of the complacency, perhaps, that investors had prior to this announcement from the president this morning.
Yeah, you know, the trade situation is one, of course, that's been one of the major market movers this year. Bloomberg has a really interesting index called the Global Trade Policy Uncertainty Index. It's been in a steady rise, essentially, since the election. It peaked on April 9th and has come back in since that time. I think what's most interesting is if you look at the S&P 500 returns, since about mid-February until April 9th, you'll see that it's moved in the exact opposite direction of that uncertainty index, meaning as uncertainty has increased, the S&P 500, of course, has declined. And then as the uncertainty index came back since April 9th, the S&P 500 was in positive territory again. So clearly it's this trade policy uncertainty that's been one of the major market movers. Tariffs, we think, still have a ways to go. I mean, the bill that was passed in the House recently, $3.8 trillion of tax cuts. The plan, of course, is to replace tax revenue, whether it be on the income tax side or the corporate tax side, with tariff revenue. The way that the bill stands right now, the math just doesn't work out. So we need to see some more evolution in that bill and the tariff revenue potentially to get to a place where that equation starts to make a little bit more sense.
And if the lesson of this morning is that the uncertainty on tariffs remains, what do investors do then? We have gold hitting a record over the last 2 weeks this morning, for example, but we have the bond market still a little bit seasick. Where can investors find some safety?
Yeah, we think the best thing to do at this point is to really hone in on the data. The data isn't providing a very clear picture at the moment, but it could potentially end up that way. At this point, you're seeing a little bit of divergence when you look at the hard economic data versus some of the soft data. On the hard economic data front, looking at things like GDP and inflation and labor is going to be very important. You know, the first quarter GDP print, I know, was very startling For some people coming in at a negative 0.3%. But when you start to look at some of those line items, it was very clear that things like import and investment were showing that corporations were pulling forward demand, meaning that they were stockpiling some inventories in anticipation of tariffs. But if you look at some of the more recent GDP data, the Atlanta Fed GDP now, for example, is up at a positive 2.4% for the second quarter. So that makes us feel like, we could see some solid growth here. And inflation is still trending above the Fed's target. But we do see a situation where it could be potentially limited to just goods. Durable goods, non-durable goods will be hit, of course, with higher import prices and tariffs, but shelter and services don't necessarily have to be. They're currently in a disinflationary or flat trend line, and that could continue to be the case. And then the labor market is really in a Goldilocks type of situation right now, where it's not so hot that it's pushing inflation and wage pressures up, but it's also not so cold that it's caused the consumer to go off of a cliff. So focusing in on that data, we think, is going to be important.
Yeah. I want to get your perspective on yields. I know this is the topic du jour. Greg Ip at the Journal had an interesting perspective. To put this into perspective, he says at 4.55%, the 10-year Treasury yield is back to where it started the year, but still below the 5% hit in the fall of 2023. So from his perspective, this is not a signal for panic, a prelude to crisis, or a lender strike. Do you agree with that?
We think the 10-year is going to end somewhere in the range of 4.25 and 4.75. And at that level, it gives the Fed a little bit of cushion to continue to start to cut rates over the next 12 months, which we think is going to be an important point of relief for the market. And that also gets us to a point where the yield curve is in more of a normal territory, meaning the short end of the yield curve has a comfortable cushion against that zero bound. And then we have about 50 or 100 basis points of premium as we get up to the 10-year.
And I want to add to that great point that Hope brought up, because Japanese yields were up as much as American bond yields this week. What are the global moves in bonds signaling to you about inflation scares, growth scares on a global stage?
Yeah, it seems to us that the movements that we're seeing globally in the bond market and that we're seeing in the U.S. dollar with declining U.S. dollar so far this year indicate that people are concerned. And there's really two levels of concern. One, that the U.S. could end up in a recession, or two, that we're going to have a very difficult fiscal situation here in the U.S. And neither of those things are frankly good and cause for concern.
And also to Madison's point, the global story here is the question of American exceptionalism. And Jamie Dimon this week saying that he worries about U.S. supremacy and exceptionalism, but that he's also never quite believed in it. So are global investors coming to the same conclusion now?
I think they may be, because of some of the soft data that we're seeing. If you look at things like business sentiment, consumer sentiment, some of the global shipping data, all of those things would give people cause and think about whether the U.S. exceptionalism is still going to continue. Chief Executive came out with a really interesting survey of U.S. CEOs, indicating that 76% of U.S. CEOs at this point feel that the tariffs as they are today will be either bad or very bad for their businesses this year. And then 40% anticipate that they're going to have to cut spending, whether it be on CapEx or on labor. If it happens to be spending cuts on labor, that could be problematic for the economy, because then you'd start to see potentially mass layoffs, higher unemployment rate, and that hits the consumer, of course. And the consumer is such an important driver for U.S. economic growth. 70% nearly of U.S. GDP is consumption. The consumer has started from a fairly strong base to this point. You see very healthy personal balance sheets. You see high levels of wage growth, high levels of employment, and they have historically shown themselves to be somewhat resilient, especially when you look at the upper income earner, which are doing a disproportionate amount of spending in the country. You saw through the inflation spike of 21-22 that they continued to spend, and we could see that. But certainly when you look at the sentiment numbers, it gives you a little bit of an indication that there could be some cause for concern there.
And Amita, speaking of concerns, I wonder what is a concern that you think investors need to keep in mind as they head into their Memorial Day weekend vacation plans that they might be ignoring at the moment? What is the single piece of research or thought that you think investors should really spend some time mulling over this weekend?
Yeah, I think one of the things is to think very carefully about some of the global shipping data that we're seeing. I mean, when you start to see things like 60% declines in shipments from the China to the U.S., when you start to see 30% declines in import volumes through the Port of Los Angeles, when you start to see a huge number of cancellations for trans-Pacific routes, that's something to think about very closely. And consumers are going to start to feel that. You know, if you order things from Shein and Temu, for example, you know that that de minimis exemption on smaller priced packages no longer exists, and those are going to have to go through customs just like everything else done. It's going to slow down things like commerce coming from outside of the U.S.
Yeah, I was shocked to see a stat this morning indicating that shipments from China are lower now than they were right after Liberation Day in the month of April, even though we are in the midst of this 90-day pause. So it's a great point to continue to look at that indicator. Amita, thank you so much for joining us this morning. Really appreciate it. We're going to have all your markets action ahead here on Yahoo Finance, so stick around for more. You're watching Catalysts.
Investors want to know, is now the time to buy tech, especially with Nvidia's make or break earnings just days away? Now, lately, Nvidia has been driving over 10% of tech sector returns and nearly 6% of the entire S&P 500. I'm Jared Blickery, host of Stocks in Translation. Check out this chart here. Relative strength and Nvidia. This is against the Spider XLK. So Nvidia divided by XLK. From 2016 through 2023, Nvidia was tech's unstoppable force, riding the AI wave higher. But notice the shift over the past year. The ratio has flattened out. Those pink dots, those are earnings dates. And the last four reports did not create new highs in relative strength as they have in recent years. So the question for investors is Nvidia losing its edge? Now let's take a look at correlation, how closely tech tracks Nvidia. At 0.85, and it only goes up to 1, this is near the highest level since the AI boom kicked off. Tech stocks now move in Nvidia's shadow. That means if Nvidia misses, the whole sector feels the pain. And if you're underinvested, when Nvidia soars, you miss out big time. So combine both of these charts and you can clearly see stalling leadership and sky-high correlation. They spell asymmetric risk ahead of the earnings print. If Nvidia delivers a blowout, then tech likely moves higher, but the gains might not be broader. So if Nvidia disappoints, expect tech stocks to drop in lockstep. The bottom line for investors, short-term traders might scale in or hedge ahead of the report, but longer-term investors, ask yourself, is Nvidia still the engine of tech, or has it turned into a potential liability? We'll find out next week. Tune in to Stocks in Translation for more jargon-busting deep dives. New episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Thank you so much, as always. Appreciate it. Now time for some of today's trending tickers. We are watching quantum stocks, Mountain and Workday. First up here, quantum stocks pulling back after soaring on Thursday. This came after the CEO of IonQ said he sees the company becoming the Nvidia player of quantum computing. That rally helped push IonQ's market cap to above $11 billion. Hope King still here with us to discuss. And Hope, I thought it was hilarious yesterday as we were reading these headlines that if a CEO just compares himself to Nvidia, then wow, you'll get a stock pop like this. But obviously, it comes in the context of quantum having a great week as well.
Yeah, I mean, having interviewed the CEO in the past, he is known to be somebody who, speaks quite confidently about any product that he is backing or that he's part of. So not a surprise. And I think to your point, you add Nvidia in the equation, and you have the association of that really accelerating. I mean, the pullback today is, of course, because the broader markets are also pulling back. But IonQ specifically, though, I think for investors, is this pure play quantum company and one of the first ones to become publicly traded. If you look at some of their peers like D-Wave Systems, IBM, Rigetti Computing, I mean, these are companies that are still in the mix, but I think for investors specifically who want that pure play, like the Nvidia, right? So I guess from that perspective, the analogy isn't so far off. You could say that this is where an investor might get really, really excited because they could have all of their chips into this one particular part of the tech sector.
Yeah, no, exactly. And it's definitely going to be a stock to continue to watch for our audience. But let's move over to Mountain soaring. And it's an icy debut on Thursday, closing at $26.36 per share, above the IPO price of $16, rising 60% after that IPO. The ad tech platform platform, raising $187 million in the offering. Trading was briefly halted because of that volatility here. And just taking a look again, Mountain having a net loss of over $20 million in revenue for the first 3 months of 2025, compared with a net loss of just $15 million on revenue a year earlier. So seeing a little bit more losses, but obviously in terms of the market action, people wanted to get in on this IPO regardless.
We haven't had very many IPOs, especially ones that have a celebrity attached to it, like Ryan Reynolds, who is a very attractive from an investor perspective. But also, I think because the business that they're going after, I mean, you know, the company is targeting small businesses that want to be able to advertise on streaming. We know that that's where audiences are flocking to. So from that perspective, if you look at the revenue streams that they could get from this influx of, you know, businesses that need to advertise on other networks away from social maybe, then this is a really attractive, a really promising kind of company. And that's what I think investors are also banking on, is this trend of streaming becoming bigger and bigger, of there being more inventory for advertisers to, you know, buy against. And then that, of course, is going to do very well for this company.
Yeah, and that's something that the CEO, Mark Douglas, has spoken with our network several times about in terms of the advertising opportunities for the company going forward, too. Finally, here, let's talk about Workday, forecasting disappointing quarterly subscription revenue as clients pull back on spending. Still, the human resources software company topping first quarter expectations. The company also saying its board authorized a share buyback of up to $1 billion for outstanding shares. The stock down 11%. And also, I think what's really interesting here is, of course, this could be added to our bucket of soft data indicators about how businesses are doing.
Well, especially if you look at the kind of clients that Workday goes after, and these are companies that have massive bases of employees who, if they're shifting them around, you know, adding or subtracting in a very uncertain environment, that makes those clients maybe a little bit less confident in how much they can spend on software like this. I do believe, though, ultimately, I mean, these workforces are very large. I think Workday has a pretty strong market position in what they do in their SaaS, you know, vertical. So maybe this is just like a blip for now, but it certainly, to your point, is part of the mix of the soft data.
Yeah, absolutely, especially when you look at that weakness, and certainly seen that play out in the price action of that stock. You can scan the QR code on your screen to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. We're going to have all your markets action ahead, so stick around. You're watching Catalysts. Nvidia set to report first quarter earnings on Wednesday. Options traders tracked by Bloomberg predicting the stock will likely gain or lose as much as 7.4% the following day. That would be a lower level of volatility than what we've seen the last 8 quarters, with an average swing of over 11%. Joining us now, we've got Sean McLaughlin. He is All-Star Chart's chief options strategist. Sean, great to speak with you. I know you've sent over in your notes that if you were trading Nvidia right now, you'd be positioning for a neutral to positive earnings reaction. Talk to me about why that's your base case.
So what I tend to see happen when earnings events happen is that if there is a surprise move in the market, that surprise move tends to happen in the direction of the underlying trend. And there's no denying that the underlying trend in Nvidia and all of the quantum stocks has been up, coming off the Liberation Day lows. And so if there is any surprise, I think that Nvidia is going to be higher. I'm not necessarily predicting that we will have a huge pop higher, but I think if there is one to happen, odds are it will be higher. I think more likely Nvidia is going to have maybe a little a muted response, a little underwhelming response to the market or to expectations, and therefore, as an options trader, I want to play this earnings event with an option spread that pays me whether the stock goes up, the stock goes sideways. Really, I just don't want it to go down very big. That's the way I'm playing it.
Sean, can you operationalize that for me and for our options traders listening? What exactly is your approach to that?
Sure. So I'm going to utilize an in-the-money call spread, a vertical spread that it consists of an in-the-money option or in-the-money call and an at-the-money call. So what I'm doing is I'm leveraging the fact that there's a lot of premium at the at-the-money strike. So looking at Nvidia right now, it's trading at 130, in the neighborhood of 130. So I want to be short the 130 strike, but I want to buy the 120 strike. So there's $10 wide difference between those strikes. And I want to position in the options that expire next Friday. That's May 30th. That's the soonest expiration following earnings. And because I'm getting a lot of premium to sell that 130 strike right now, if Nvidia were to absolutely crash, I don't think it will, but it could, right? It could happen. Well, playing this event with an option spread, I will be better protected versus, say, a normal stock trader. If I'm long Nvidia stock and the stock gap's down to, let's say, 110 or 120 following earnings, I'm going to lose a lot more money had I been positioned in stock versus the options, because of the fact that I'm selling premium at the money strike, which really gives me a lot of cushion.
And my guest host, Hope Kane, has a question for you as well, Sean.
And I just feel, hey, good to see you. I mean, look, you are well positioned on either side. I'm just curious why there is still such, I guess, or there can be pessimism going into this, especially because, as you mentioned, I mean, typically they do surprise. On average, it looks like the stock is likely to gain or lose as much as 7.4%, though. So where is that pessimism coming from?
Well, I think there's still lingering doubt. There's lingering, PTSD for what has happened in the market recently, and even today with what we're seeing with the tariff news driving, market jitters a little bit. So there's always going to be fear, and Nvidia is one of those names that everybody watches. It's on everybody's radar, and you're not only do you have people who are perhaps fearful and they're protecting their positions using options, but you also have speculators who are driving the prices of calls and puts higher because they're making aggressive bets that something may happen. We've seen what happened with the quantum stocks yesterday. You guys were just talking about D-Wave and IonQ and Rigetti. Those stocks had huge gains yesterday. I mean, 20, 30%, I believe, is what I saw. And seeing the pullbacks that we have today in those names are only down 1 or 2 or 3% right now. That's a very mild pullback following a really strong day yesterday. So all of that to me speaks that the setup is there for Nvidia to at least not disappoint. It may not make everybody excited, and we may not see a 20% gap higher, but I think the market is positioning for Nvidia to be neutral to higher, and that's why I'm trading it this way. And yeah, are people pricing at a 7% move? Yes, it's a popular name. People are looking at it as a bellwether. I think it's more speculators that are driving that, though, than fear.
Okay, I like that. One of the fun parts about doing earnings and covering them is you see the initial movement based on just the first print, and then you get the earnings call, and then it does all kinds of things. Stocks will do all kinds of things. For me, Blackwell has been the key word that I've been listening to the past couple of quarters. With all of the deal making, though, in the Middle East and this new partnership with Humane, this Saudi Arabian AI company, is that going to be something that you're listening for in the commentary?
Well, I hate to disappoint you, Hope, but I'm more of a technical guy. For me, only price pays. For me, all the truth is in the price. And yeah, I could listen to conference calls and I could hear what everyone's saying, but they're a little bit biased, right? They're trying to spin a positive story, keep everybody engaged, and keep investors happy. And nothing wrong with that, but for me, it's all about price.
Sure.
And the price will tell me what I need to do next.
But there are other people, other traders who listen to this and their price impacts you. So how many people do you think would be listening for this specifically, given this is the season right now for tie-ups and partnerships? I mean, they just showed up at Microsoft's conference the other week and talked about their partnerships. So I think that's sort of what I'm coming from, is that yes, they're going to talk up that big game during the earnings call, but I do see that they're trying to show that there is potential beyond their current product stack.
Oh, absolutely. I mean, Nvidia is the name, right, that everyone's watching. They're looking for clues for AI, for quantum computing. I mean, if Nvidia says anything that spooks investors, that affects the entire space. So yes, people are going to be paying attention. They're going to be trying to read the tea leaves and read the clues that are said. I mean, we have body language experts that will look into that stuff and see how people are reacting. I mean, it's going to be overanalyzed to death for sure. And there's going to be a lot of meat on that bone for people to analyze. But again, for me, it just comes down to price. The price is what will tell me where we need to be.
John, thank you so much. Really appreciate it.
Thanks for having me.
Coming up, we're talking to Intuit CFO about the company's performance in the latest quarter and why AI is proving crucial to the business. That's when we come back. Stick around. Shares of Intuit moving to the upside this morning on the back of the company's stronger than expected results. Intuit raising its guidance for the full year, expecting revenue growth of 15%, the prior estimate of 12%. Joining us now with more, we've got the CFO of Intuit, Sandeep Aujla. Thank you so much for joining us on the quarter, Sandeep, and the stock hitting an all-time high as we speak here. You were able to lift guidance moving forward when so many other companies are pulling guidance entirely or at least lowering it here. Talk me through how you were able to do that.
Good morning, Madison. Thank you for having me. You know, it was an outstanding quarter. We saw our tax business get back to double-digit growth. The momentum in Credit Karma continues with over 30% revenue growth. Our small and mid-market platform continued to scale at a healthy 19%. So outstanding quarter, but really what's exciting, to your point about 15% growth, is the momentum that we have in the business. The company is truly firing on all cylinders, and it is that momentum that gave us the confidence to ratchet up the guidance as strongly as we did to 15% growth, which is the fastest organic revenue growth in the last decade. And while we're bringing new innovation to market across AI agents, while we're disrupting the assisted tax category and growing that revenue 47%, while we're building a go-to-market motion to go up-market in businesses, we ratcheted up our margin guidance by another point. So as a company growing 15%, delivering over 40% operating income margins. So really feel good about how we're set up, and I'll give it to continue to execute on our strategy, and once again, firing on all cylinders across this company.
And Sandeep, we've talked about policy coming from Washington before. The last quarter that I was able to speak with you, we talked about DOGE cuts, and you explained that you see that as a lift to your business. Obviously, the topic of the day in Washington right now is the so-called Big Beautiful Bill that includes extensions of tax cuts. How does legislation like that impact the company going forward?
Sure. Let me open up the aperture a bit on the question, just talk about the broader policy and the impact on our business. On the tax side, the extension of the tax filing, but more broadly, the interest of the government to eliminate waste, to have a better partnership with the private sector, will continue to be a tailwind to our company. As an example, the government is looking at better APIs across IRS so that we can provide a better tax filing experience for our customers, so that our customers could have a better insight into how their filing is progressing through the IRS system. And they're also looking to eliminate waste, such as the direct file program. So all that continued tailwind to our business. If you allow me, I'll add one more dimension to the macro environment. Today, a lot of questions around the tariff and how those are impacting businesses such as ours. We serve nearly 10 million mid and small businesses. And these businesses are across a range of industries and across a range of sizes. And 70% of these businesses are service-based businesses, so they are not directly impacted by the tariff. And what we continue to see in our data is stability. And that stability is definitely a good aspect for our business as we look forward. So we continue to watch the sentiment, but I see the macro to be a stable environment, and I expect the government and private partnership to be a tailwind for our business, as we talked about last quarter.
I think just on the small business point, and, I haven't had the privilege of speaking to you as often as Madison has, but looking at U.S. small business sentiment, it actually has continued to fall. So is your sweet spot the sectors and the businesses that are, as you just said, services? And so are the small business confidence numbers that are falling among small businesses that are actually products and goods and actual tangible, things that they're selling?
Hi, good morning, Hope. Good to be speaking with you. For our business, I completely agree with you. While the sentiment is something that we are watching carefully, I look more closely at the data and what the data is showing us. And what the data is showing us is what I would describe as stability. And there are certain areas, such as manufacturing or wholesale, which is a small component of the business, where we did see slight pullback in April. The two factors that I look at most closely are the cash reserves that these businesses have across the board. And I'm seeing that be up about 5% year over year. And that's a very strong indicator in terms of the health of those businesses. The second indicator I look at, and this is more of a leading indicator from our perspective, being in this business for multiple decades, is the number of hours worked by employees of the small businesses. And those number of hours worked are flat year over year. So yes, the sentiment is something that we should continue to watch carefully, but what the data is showing us is continued stability across the small and mid-market businesses.
And just on this last note of soft data and sentiment, I was at a conference last week with CFOs across many, many sectors of the economy, and the general sentiment there was one of pessimism, especially because tariffs are introducing all sorts of uncertainties, as you know, and I hate using that word so much, but I'm curious, do you fall in that same camp? Do you feel, for the overall economic picture of the U.S., that there are more worries ahead than there are bright spots?
You know, we are a company that's been around for 40 years. We have our playbooks to operate through any macro environment, and what we focus on day in, day out is generating management alpha. So the way I would describe our sentiment internally is one of optimism about the upside we see executing on our strategy, regardless of the macroeconomic environment. So with us bringing AI agents to serve the small business and mid-market businesses, which is going to be a massive productivity and better decision-making capabilities for them that should help unlock even further growth for these businesses. For us, continue to disrupt the $35 billion assisted tax category. These are all areas that, for us, executing on a strategy and building upon the momentum that we have is an area of optimism. And I take a great deal of confidence in our playbook and the experience we have managing this business throughout any macroeconomic environment, that we will be well-suited regardless of what comes ahead. The last thing I would also say, and it's an important factor to keep in mind as it comes to Intuit, over 80% of our revenue is on a recurring or subscription-based businesses. And many of our products are very high in the hierarchy of need for these consumers, for the small businesses, for the mid-market businesses. So that also gives the company a healthy degree of resilience going through any potential economic cycle.
Sandeep, I want to end on labor costs for the company going forward. Obviously, you utilize AI tools from human experts, as the CEO mentioned on the call, but also more broadly as tools across the business. How are you thinking about labor as a cost-cutting measure going forward? Do you have any plans to lay off staff?
Let me address the last part. No plans to lay off staff, period. But let's talk about AI. We see two prongs to AI. One is delivering breakthrough experiences to our customers, the consumers on our platform, the small and mid-market businesses, the nearly 100 million customers we serve. How do we bring AI to them, bring agentic AI agents to small businesses that do the work on behalf of these businesses, so our entrepreneurs can focus on growing their business as opposed to stitching together 3 to 10 apps to go run their business. So that's on the customer side, and that's resonating well. And in the coming weeks, we expect to have AI agents available to the nearly 10 million customers on our business platform. Now let's talk about efficiency, where your question was. We look at AI to rethink how Intuit works. I shared last quarter that we're seeing on run rate 90 million plus of cost savings on a customer service platform by using AI in how we schedule our agents, how we train our agents, how our agents use AI to address the customer's questions. But we're also seeing AI drive up to 40% productivity improvements for our developers. We are using AI in the finance function to take out repeat costs. So across the company, I see AI as a tailwind for us to continue to scale our business at a healthy rate while delivering improved margin expansion.
Sandeep, always appreciate you making the time for Yahoo Finance. Thank you so much for joining us.
Thank you, Madison. Thank you, Hope.
Thank you.
Let's stick with artificial intelligence. Jony Ive, the man behind the creation of the iPhone, teaming up with Sam Altman of OpenAI this week in what could be a potential threat to the big tech companies that are searching for AI supremacy, with Apple, Microsoft, Google, and Amazon all investing internally and externally to achieve those goals. Still with me here to discuss is Hope Kane. I'm really excited, Hope, to get your take on this, the rollout video too, on Sam Altman and Jony Ive's relationship here. How are you thinking about the impact this could have on OpenAI on these other tech companies?
I mean, what a move, and it's a move we've seen from Sam Altman and OpenAI before. Last year, before Google I/O, they also released another product. And so this is just really their same playbook, but they really upped the ante this year because they announced this acquisition on the second day of Google I/O this week. The company that they acquired is called I/O. So when you go on X, someone noted that if you typed in I/O, it's not Google I/O that comes up, it's this acquisition. But I think with the larger picture for I think Sam Altman and OpenAI is, they're getting into a space that they could really disrupt the rest of big tech. Because if you own the device, if you own the actual entry point into the AI systems that, we're using more and more, there is no reason for you to go and use Gemini or, use Siri, another phone, and to take, this very beloved figure in consumer product tech design, Jony Ive, under their belt. I mean, he's not joining, most of the team is, but that is a huge, huge stake in the ground. And I think to Sam Altman's kind of strategy here, I think he wants to be able to disrupt in a way that Google can't because they're so much bigger at this point.
It also makes me wonder when last night when I was thinking about talking about this, I was thinking of asking you about the competition between OpenAI and Gemini, Google's LLM. But now I'm thinking about how Apple plays into this, given that stock's under pressure after the president's tariff tease this morning on Truth Social. How much does this actually put a risk into the room for Apple with phone dominance?
I actually think that's a great point. And we know that Apple has been under fire this year, has been under pressure because their AI hasn't delivered. Well, if your phones are going to go up in price, if it's going to disrupt your manufacturing supply chain, and you're falling behind on the most important software of the day, of the future, that I actually think it's a brilliant question. And they've got Jony Ive now. We don't know what this device is going to look like, obviously. But yes, now they're really going to be behind on this if they can't get their iPhones to deliver on the AI promise that they've been talking about, for the last 2+ years. So I love that you were thinking about this last night. I think that it's a great connection point. And as we know, Apple, like Nvidia, it used to be one of those stocks when earnings came around, you'd never wanted to bet against.
Yeah.
But more and more, I mean, they still have performed, fairly well, but more and more, you're seeing the concerns start to creep in, and it's because the software is becoming this AI software is becoming more important to their strategy in the future.
And something else that our steward here, executive producer John Hyland, flagged to me this morning, Humane selling to HPE for like $200 million, and that turned out to not necessarily be successful. We also know Jony Ive, he had that AI gadget that was sort of like that pin that was going to be on your chest that didn't necessarily take off as well. So is there a chance that Sam Altman isn't betting on the perfect person for the job?
I mean, I think, it's sort of like the Ryan Reynolds. I mean, it's not exactly, but when you have somebody who is as well known as Jony Ive, when you have somebody that can give you a boost in an area that, OpenAI is still software, in an area that they currently don't have product in, I think it's going to grab a lot of attention for a really, really long time. You're going to get the curiosity of people who are just waiting now for the product announcement. It's going to hang over every single tech company for the next couple of quarters and years, depending on how long it'll take for them to actually release something. And the other interesting thing about Apple, as you mentioned earlier, is they also are looking at their hardware strategy. They have these new glasses that they're planning. That is part of this launch of new hardware. I own a Vision Pro at home. It currently is sitting pretty much unused, but I love being a first adopter with tech. And the problem with the Vision Pro is obviously it's very bulky. They're making kind of this Warby Parker move with kind of Google and with Ray-Ban and Meta of making it smaller. So I think if they can make a splash with those glasses, if Apple can make a splash with those glasses, maybe they have a chance in recouping some of that attention that they've lost.
A first mover advantage on a new form of hardware, potentially. Rope, thank you so much. Really appreciate those insights. Coming up here, why one financial advisor says there could be winners and losers of the GOP's tax bill. We'll get you those next. Stocks moving to the downside this morning as investors weigh the president's suggestion for additional levies. Meantime, Treasury yields rising after 20-year bond auctions saw weak demand earlier this week. We're actually seeing yields move to the downside. Treasury's catching just a bit of a bid because we've got a risk-off sentiment in the markets this morning. But all of the volatility makes us think about the 60-40 portfolio and whether investors should be rethinking it a bit. Joining us now to discuss, Jamila McClooney, financial advisor and Black Wealth Foundation. We are joined now with her for the FA Corner this week, sponsored by Invesco. Jamila, great to have you here. So I want to talk to you about how investors should be approaching this idea of the 60-40 portfolio, given all of the volatility that we've seen in the bond market and also the stock market over the last week. What are you telling clients about that allocation?
I think that's a great allocation to still look at. We're looking at equities being strong, and I believe investors are aware of the volatility that's just systemic and that could come at any moment from a tweet from the White House. So they know it's coming, they're prepared for it, they know what it feels like, and I believe they're able to stay strong in that 60-40 mix.
And it's interesting because Bank of America's Michael Hartnett this morning said that investors should actually look longer across the yield curve at something like the 30-year yield, for example, and 30-year treasuries. How are you thinking about allocating capital across the yield curve? Do you see more opportunity in those longer dated treasuries?
I believe the longer term data does tell us something. We have the data to look back on. And I believe over time, just that longer look will kind of pan out and give us a better estimate of what to expect just based off of the history of what we've seen in the past.
And my guest host, Hope Kane, has a question for you as well, Jamila.
Good morning. It's great to be with you. I'm curious, when you look at the consumer landscape, because we know that consumer spending ultimately impacts everybody else in the economy and companies, what do you think consumers should be most concerned about with the tax bill?
I think consumers will initially be excited with the tax cuts. I think they'll see spending based off of that. When taxes go down, it frees up money. But I do believe there will be a delay and a little concern over time. The social programs cutting there, the tax bill over time, Moody's downrating the credit rating of the U.S. I think that ultimately what will look like an initial benefit overall may give consumers pause.
And when you say it'll give consumers pause, walk me through some of the questions that you are getting from clients and what they're asking you about what to do with their portfolios in a year with such volatility.
Yeah, they want to know, what's going on. Is there any type of preparation that they can do, should do? What sector should they be looking to? Should they pull their money? Should they keep contributing to their 401k? There's a lot of fear and uncertainty in the market. And when you have data that comes out like tax cuts, people are excited about that. But when you look at interest rates that may go up as a result, or like I said, the social programs being cut, the green tax incentives being cut, which was a major incentive for the solar and EVs, it's kind of scary on the other side. So it's like winners and losers, but where do we come out if we take advantage of the free money that we have, that we freed up, and the spending that we're able to do? What does that look like over time later when some of that volatility begins to kick up?
And I think you mentioned this with the investors that you're speaking with and that you're helping, that they are really kind of settling into the market volatility. They're sort of used to now this chaotic cadence, and there are some areas of safety. And I think you've got some sectors that you have your eye on. What are those?
I think gold looks strong, for times when there's increased inflation or pressure of inflation. Utilities, AI actually has been pretty strong and encouraging. So I think those sectors are things that clients are looking at to see how they can get in to diversify and kind of not have all their eggs in one basket.
Jamila, really appreciate you making the time for us this morning. Thank you so much.
Thank you.
That was this week's FA Corner, brought to you by Invesco. I want to get some final thoughts here with my co-host for the hour, Hope Kane, the founder of Macro Talk News and a Yahoo Finance contributor. Hope, it's been quite the year to date. It's been quite the week for stocks, for bonds, obviously, of course. What is top of mind for you heading into the weekend?
Heading into the weekend, nothing. I don't want to think about anything going into the weekend. But no, I think this is the pace that we have to get used to. I think I remember a time when weekends meant something, and now they don't, because you might wake up to a Truth Social post or a tweet or a proclamation of some sort, and then we're back on the wagon trying to figure things out. So I think this is what is going to be the foreseeable future for the next maybe year, 2 years, 3 years. But I think it's this pace of, and I mentioned earlier, indigestion. Yeah. I mean, it's just a lot for any one person, but especially for investors to take in, and at the pace that it's coming, but also at the kind of there's so many unpredictable factors. You have in April Liberation Day, and then a week later you have the pause, and so you're always on edge, waiting for the next shoe to drop, and that is a very stressful way to live. But it is how we have to live right now as investors, as journalists, as everybody who has to kind of work through the next couple of months. And it's no wonder, and you mentioned this too, companies are pulling back on their forecasts, their guidance, because there is just no way to predict the future at this point.
Exactly, and they would rather not have the analysts be mad at them in the quarters to come. They'd rather just pull the guidance and say, we're not sure.
Exactly.
So Hope, giving us so much to think about and great context for the hour. Really appreciate you joining us. Thank you so much. Coming up here, we've got Wealth. It's dedicated to all of your personal finance needs. Our very own Brad Smith is going to have you for the next hour, so stay tuned for more.